everyone, welcome and thank you for joining us for today's webinar as we present the results of our 2012 Hedge Fund Operations and Technology Benchmark Study. My name is Kaylee Alessandro. I'm the Marketing Programs Manager here at Edge Integration, and as always, I'm thrilled to serve as your host and moderator. Now in its second year, our Hedge Fund Technology Benchmark Study is designed to give you a closer look at the vendors, products, and services being utilized by your investment firm peers today to support their day-to-day operations. Before I introduce our speakers, let me share a little bit of background on Edge. We are the leading provider of outsourced technology solutions and private cloud services to the hedge fund and investment management industry worldwide. We were established in 1995 and today have offices in 8 U.S. locations, as well as international offices in London, Geneva, Singapore, and Hong Kong. In addition to our private cloud services, we have a solutions portfolio that includes disaster recovery and business continuity planning services, message archiving, storage solutions, project management, an award-winning 24/7 by 365 help desk, and much more. If you were with us last year when we presented our benchmark study results, you may very well remember today's speakers. They are 2 distinguished colleagues of mine, Mary Beth Hamilton and Steve Banda. Mary Beth is Edge Director of Marketing and is responsible for managing all of Edge marketing initiatives on a global scale. Mary Beth has more than 12 years of technology and marketing experience and holds an MBA from Boston College. Steve is a product manager here at Edge and is tasked with managing the life cycles of Edge products and solutions. Before joining Edge, Steve held a similar role at Fiduciary Trust Company, and he also holds an MBA from Boston College. So to kick us off, I'd like to run through our survey methodology and cover some of the demographic information that we captured through our benchmark study this year. For our 2012 study, we surveyed 320 financial services firms across both the United States and United Kingdom. 61% of respondents classified themselves as hedge funds, while other designations include investment manager or investment bank, private equity firms, fund of funds, broker-dealers, and venture capital firms. So you can get a clear picture of the firm type breakdown here on this next slide. We also asked firms to report their current assets under management. AUM segments were fairly equal in size, as you can see here, with 30% holding under $100 million, 32% between $101 and $500 million, and 38% over $500 million. In terms of geography, the majority of firms are solely based in the United States, while just under a quarter of firms have both domestic and international offices. Nearly 2/3 of firms operate out of one office location, while the other third support multiple office locations, anywhere from 2 to 5+ offices. At the bottom, you can see that the vast majority of firms have fewer than 25 employees, about 74% to be precise. However, there are firms who support employee counts upwards of 75 or 100 people as well. Moving on, as far as investment strategy is concerned, the most popular single strategy reported was long-short equity, which is similar to the results that we saw in 2011. Again, similar to last year's results, a large segment of firms, about 23%, reported that they employ a multi-strategy approach. Other common strategies include global macro, fixed income, emerging markets, and more. And interestingly, multi-strategy firms also indicated they use long-short equity 2/3 of the time. The second graph on this slide takes a look at prime broker usage by these firms. In a trend we expected to see continue from last year, Goldman Sachs once again tops the list, being used by more than 1/5 of survey respondents. Rounding out the top 5 primes are Morgan Stanley, JP Morgan, Credit Suisse, and UBS. Variance between primary and secondary prime brokers was minimal, and Goldman, Morgan, JP Morgan, and Credit Suisse remain top choices overall. So now that I have provided some insight into who our respondents are, it's time to find out what products and services they're using in the financial marketplace. Mary Beth Hamilton will now take us through some of the key front office findings our survey revealed. Mary Beth?
So these are the areas that we're going to cover: order management, market data, marketing analytics, and research and document management. First up, we're going to cover order management. Our survey found that the dominant players in the hedge fund order management system space continue to be BNY Convergex's SOMS and Bloomberg's Asset and Investment Manager order management system. Of these systems, 32% of respondents are using SOMS and 23% are using Bloomberg's OMS. While Charles River users represented a small portion of respondents, just over 2%, it is important to note that the firms using Charles River had upwards of $5 billion in assets under management. We continue to find that Charles River is used primarily by very large hedge funds and asset management firms. Now back to our two leaders, Bloomberg and BNY Convergex. Bloomberg's AIM solutions highlights the move towards vendors and service providers bundling products to increase value to clients and gain a stronger foothold across multiple facets of a firm's operation, from front to middle to back office. Bloomberg's AIM is an integrated suite of solutions. The list is long, but the capabilities that it provides include portfolio management, compliance, order management, post-trade settlement, including reconciliation, portfolio accounting, and reporting capabilities, just to name a few. BNY Convergex's SOMS is also following suit. Its bundled solution aims to provide functionality to support portfolio management, compliance, trading, and operations in a single platform. In August of this year, they expanded the functionality of SOMS with new portfolio management risk tools that include valuation and scenario tools to analyze listed equities, listed options on equities, financial futures, and financial indexes. We expect this trend of bundling and adding new capabilities to existing systems to continue ongoing into the future. Up next, we look at market data. Given that Bloomberg has over 300,000 terminal subscribers worldwide, it's not surprising that they're the most widely used, with 90% of respondents reporting they use Bloomberg terminals. Thomson Reuters is used by 20% of respondents. It's important to note here that with this question we allowed for multiple responses. As a result, we found that 80% of Thomson Reuters users also have Bloomberg terminals in place. Now let's talk about what's going on in the market data space. Bloomberg continues to make enhancements to its Bloomberg professional services in an effort to maintain market leadership and while expanding its client base beyond its traditional stronghold in trading rooms. In June 2012, Bloomberg announced a global rollout of Bloomberg Industries, a research platform that combines analysis and thematic insights from 100-plus industry analysts with Bloomberg's industry data, news, and analytics. As a representation of the geographies covered, about 60 of those analysts are based in the U.S., while 30 are based in Europe, and the remaining 10 in Asia. Bloomberg Industries senior analysts create and manage in-depth data and analysis for each of the industry's drivers, metrics, competitors, themes, and earnings. The portal aggregates the information from more than 200 third-party providers, and the tool is really aimed at analysts and investment banks and the fund management industry, as well as portfolio managers, investment bankers, and IR executives. Aiming to keep pace with Bloomberg, Thomson Reuters continues to add new features as well. Just this month, they announced an agreement to create and distribute a set of fixed income derived analytics from BlackRock Solutions. Thomson Reuters' hope is that the new derived analytics could save clients a significant amount of work and expense compared with building and managing these analytics processes in-house. So with that, that takes us into market analytics. In this area, we commonly see firms leveraging the analytics capabilities built into existing systems that they already have deployed. Oftentimes, firms find that the add-on analytics capabilities are satisfactory and therefore do not warrant purchasing another standalone application. As such, it's not surprising to see Bloomberg leading the pack with over 75% of respondents using Bloomberg for analytics. Again, with this question, we allowed for multiple answers as we understand that it's commonplace for firms to use multiple analytics tools. As such, we found that 1/3 of respondents are using multiple tools. And of Bloomberg users specifically, 1 in 4 are using Bloomberg plus another tool. Another example of this trend of already having the capabilities bundled within an existing solution is Thomson Reuters offering of a combined solution of portfolio management and analytics within its portfolio analytics tool. This tool provides global equity analytics and risk modeling, credit analysis, portfolio analysis and reporting, and cross-portfolio analytics. Now, I haven't mentioned them yet, but our number 3 here is Capital IQ, with 14% of respondents saying they use them as well. So S&P's Cap IQ is the 3rd most commonly used tool. There is a module that's available as an add-on to the standalone S&P Capital IQ platform. The Portfolio Analytics module employs robust attribution and charting tools, and it couples itself with detailed reporting to examine portfolio performance, weights, and characteristics that drive active return. Next up, we have research and document management. Now, 56% of firms indicated they currently do not have a research management system in place. Of those that do, the most popular choices are proprietary in-house solutions, Advent Tamales, and Code Red. While the none category was the most popular, we do expect this to change and evolve in future studies. More stringent financial regulations, compliance obligations, coupled with boundless amounts of electronic data are making research management systems increasingly important at hedge funds and investment management firms. Speaking to regulations, Section 206 of the Advisory Act, for example, requires firms to keep any documents that lead to a portfolio recommendation. Research management systems support compliance readiness by automating and enforcing policies and building compliance into workflows. They also allow firms to harness the exploding volumes of data and information flowing into a company on a daily basis, making it more manageable, searchable, and ultimately valuable to the firm. With a research management system, firms can be in a better position to document investment decisions and ideas, as well as demonstrate really strong due diligence practices. The research management space is also embracing the move towards tablets, i.e. iPads, and other mobile devices. Vendors such as Advent Tamale have created iPad apps that allow users to post data remotely, easily inputting meeting data directly into the RMS for long-time reference, and encourage team collaboration. We expect this trend of movement towards mobile devices to continue to increase, and it's something that we touch on a bit later in this study. And with that, I'll turn it back to you, Kaylee.
Thanks, Mary Beth. Now that we have looked at the front office, let's take a closer look at some of the middle and back office solutions and technologies that funds are using today. Steve Banda, allow me to turn the reins over to you.
Okay, so if we look at portfolio accounting, it's a critical component of any successful investment management operation. And as a result, there are a number of solutions on the market. Our survey reveals, however, that 37% of our respondents are using an Advent system, either the Advent Geneva or the Advent Axis/APX system to handle their portfolio accounting. We also found that SunGuard VPM was a popular choice among firms with a higher AUM. Also, larger firms were more likely to use proprietary systems or those systems that potentially they developed in-house. However, it's hard to ignore the large number of firms that are using systems that fall into our other category. These accounting systems included TradeArm, Merlin, FixQ, and Peachtree, just to name a few, among some others. These results closely reflect those found in our 2011 study, and therefore suggest there's little net change in accounting system providers among the firms. Regarding the none category, it's possible that many of these are relying on outside administrators to fulfill the portfolio accounting function, and therefore may have responded that they did not have an internal system or a system that they're using for portfolio accounting. But in any case, the right accounting provider should meet some basic functionality requirements. And just to name a few, most would provide some sort of real-time dashboard and reporting system for accurately reporting P&L, and as well as identifying risk and exposure to investments, and therefore providing that functionality, that visibility into that. Easy reconciliation of cash positions and transactions is also a functionality component that should be included in most solutions. and also multi-currency support. And lastly, integration to other counterparties and industry data providers. So that's just a quick snapshot of some of the functionality that you should expect from portfolio accounting solutions. And as a final point, and this is something that we actually touched on during last year's presentation, and it's really the need or the upcoming need to potentially comply with International Financial Reporting Standards, IFRS. Now, although the firm deadline is still looming and to be set, this is something that when considering a portfolio accounting system, you should keep in mind as well. So now, Kaylee, if we move on to, let's see here, the risk management is the next topic I want to discuss. So as institutional investors continue to invest in hedge funds as part of their core strategy, there's pressure that remains on hedge funds to not only manage portfolio risks such as liquidity, volatility, credit exposure, to name a few, but also compliance risk such as Form PF. So our survey shows that firms are using a variety of risk management systems. And consistent with our findings in 2011, our 2012 survey shows that Advent is a preferred risk management vendor. And we also see that firms are also using in-house proprietary systems as a popular option. However, what's noticeable here is that 60% of all of our respondents indicated that they do not have a risk management system in place. And considering the importance of risk management practices to hedge funds, it's likely that they're using some other method. And one likely scenario is that these hedge funds are relying on fund administrators to provide risk management practices. And supporting this theory are the results of a joint survey that was completed recently by Managed Funds Association, the MFA, BNY Mellon, and HedgeMark. And this study reported that 91% of hedge funds that were surveyed actually rely on third-party administrators in some risk management capacity. And so through reporting services, administrators can help increase the transparency that's required to manage and mitigate operational risk, as well as help to address regulatory concerns. So in conclusion, we expect that institutional investors are going to continue to take positions in hedge funds and therefore require that strong risk management practices are in place. So we believe that firms will continue to use a combination of risk management systems as well as rely on fund administrators to augment their risk management practices, and at all times protecting proprietary information. Now, if we look at outsourced administration and consider our respondents, we found that 60% of our respondents currently outsource their fund administration to third-party administrators. And topping the list of administrators is Citco with 11%, followed closely by Goldman Sachs with 10%. SS&C, Globop, and State Street were also prevalent players. And we can expect, however, that State Street will be taking a leading position in 2013 due to their recent acquisition of the Goldman Hedge Fund Administration business. So as you can see from our results, nearly a third of our respondents employ a variety of other third-party administrators. And our list of others included 28 administrators. And just to name a few, these include Brown Brothers, Citi, Mellon, JP Morgan, among some others. And additionally, one other point is from our secondary research, we found that the larger funds were more likely to use more than one administrator. And this may be because, again, due to institutional investor pressure, they may prefer some sort of shadow accounting to further ensure financial integrity. And also, having more than one administrator could be a method of hedging operational risk in the event that the primary administrator has a business disruption. And in conclusion, the top administrators will continue to invest in technologies to provide better service to hedge funds and investment firms. By providing comprehensive front, middle, and back office solutions, they'll be able to provide a range of services from real-time P&L, trade processing, NAV calculations, to financial statement production. And a really valuable function there. So if we move on to CRM, Customer Relationship Management. So from our survey, we see that PerTrack, Salesforce, and Backstop are three of the most common CRM systems used by firms. PerTrack and Salesforce share the lead, with each with 10%, followed by Backstop, which approximately came up with 8% of respondents using that. Looking across the AUMs, however, we found that Salesforce tended to be more popular among firms with in the lower AUM tiers. However, we also found that approximately 26% of our customers use a variety of other systems, which we lumped again into an other category. And among these are Goldmine, Siebel, Navigator, Sales Logics. And surprisingly, we also found that a large proportion of funds did not have a CRM system. Now, many funds rely on these systems to help manage the capital raising process by projecting upcoming investments or creating RFPs. They will use these systems to help ensure regulatory compliance by maintaining a central repository of investor interactions and communications so that they can rapidly respond to audits. And also, these systems will help streamline follow-up process with respect to their customer base so they can improve client communication more efficiently. So in addition to these functions, there are a few trends that we're seeing in the CRM market. And a few developments I'd just like to list here to look for. So these should bring benefits to the hedge fund and investment industry. So there's a drive towards tapping into the social media conversations that are originating outside, from outside sources such as blogs, tweets, and other online discussion. These CRM solutions will also continue to centralize all the information back to a management portal where customer information is readily available, but also available in the context that you need it. And third is they're continuing to extending CRM functionality to mobile devices, such as tablets and smartphones. So this remains a core focus as well. And lastly, there's integration with outside systems, and that's a common trend across most solutions today. Now, I think at this point, Kaylee wanted to ask the audience a question.
Yeah, so we're going to jump in quickly before we move on to our next section, which is on mobile devices, and do a quick poll question to get a pulse for what kind of mobile devices your firms are using and supporting. So what I'm going to do is launch a quick poll here that should be popping up on your screen and give you guys a couple of minutes to tell us, what are you using at your firm? Is it a BlackBerry? Is it iPhones? Is it a combination? Android, Windows Mobile? Let us know. So it looks like our answers are coming in fast and furiously. I'm going to give you guys about 10 more seconds. Great. Thank you all for sharing your results with us. I'm going to close the poll and share the results with you now. And as you can see on your screen, almost 3/4 of you are using iPhones and iPads. In addition, though, almost 70% of you are also using BlackBerries. So my expectation is there's probably a combination there. And we can let Steve talk about these a little bit as we share our survey results.
All right, thanks, Kaylee. Well, thank you for responding to that brief poll. It's very useful information. As we can see, really there's a fast trend towards adopting a variety of devices. And maybe you've heard of the buzzword, the BYOD, bring your own device. And that really references this craving for everyone to take advantage of the new functionality that's on these, on the iPhones, on the Androids, and other devices, really moving away from essentially BlackBerries that have commanded the audience for historically the corporate audience. So with the BYOD movement, it's important to understand how we're going to control the risk that this presents. So there's one thing that I want to mention, and I mean, first we can look at our results. You see that we have 95% BlackBerry. Well, we're seeing this trend. I mean, if we compare this to 2011, where in 2011 we still had 95% BlackBerry, but we only had 10% of Apple and iPhone. So now we're up to 30% with the Apple and iPhone, and a similar increase with the Windows Mobile and the Android from over last year. So we are definitely seeing that trend where a variety of devices are being selected. So where I want to go here is, what does this really mean for firms, for investment companies, for hedge funds? This means that the enterprise data is moving to a variety of tablets and smartphones. And this really will create a major security challenge in order to protect company data and client information. Fortunately, there are mobile device management solutions, and the acronym for that is MDM. And these are used by IT to manage this convergence of work as well as personal information on these devices. And the goal is really to enhance the visibility and control over the devices that are on your corporate network. Now, effective solutions will really provide complete transparency, so a 360-degree view of all of the mobile devices on your network, all of the information on your network, so that you can ensure maximum protection. Now, there are a few layers I just wanted to discuss in terms of visibility that these MDM solutions should provide. So the first is on the devices. There should be, as I mentioned, a complete inventory of the devices. So understanding what models, what operating systems that are accessing your network. And an additional function would also being able to identify if there's an unknown device that has access to your network. Now, the second level is the application. So you need to have the ability to restrict downloading applications as well as being able to provision applications across a user base. So this is a second level that the MDM solutions can provide. Now, with respect to controlling the content, there may be as you know, very sensitive information that you need to protect. So certain files should be able to be encrypted or password protected for that level of protection as well. And in terms of user activity at another level, certain MDM solutions will be able to identify behavior patterns that can be analyzed. And in many cases, this may be able to identify if there's a pending attack on the network, or also just to control costs such as roaming or other usage that could be occurring. And last layer is what they call the context layer. And this is just really being able to match who did what, when, and where. So to wrap up, some other general security measures you should expect are the ability to lock down, as I mentioned, applications, but also cameras and other functionality that you want. You should be able to enforce passwords and also ensure that there's encryption. So as you can see, these solutions are comprehensive, but there are quite a few out there. So a couple I'd like to name just to give you a sense of which ones are good that we've seen is Mobile Iron, a lot of very good functionality. Good Technology, Symantec, and actually BlackBerry Fusion has a product. So there are a bunch out there, but feel free to reach out to us if you'd like more information on the MDM solutions on the market.
Great, thanks, Steve. I'm going to quickly turn it back over to Mary Beth Hamilton to talk about message archiving.
Yep, so switching gears to another form of communication. This survey found that Global Relay is the top choice of firms, with 50% of respondents indicating they have a Global Relay solution in place. As part of full disclosure, as Castle Integrations, as Archive solution is powered by Global Relay, so we obviously see this trend as well support them as being the key solution for the hedge fund community. Other commonly used solutions are from Smarsh, FrontBridge, and Postini. Now, looking at what's driving the need for archiving, the SEC requires investment advisors to retain all internal and external electronic business communications. There are, in fact, two primary SEC rules that relate to record retention for Investment Advisors Act. Rule 204-2, which we touched on in the research management section, requires firms to retain all internal and external business communications. Now, if we consider the second regulation, Rule 206-4-7, this requires that firms adopt a written compliance program. Obviously, this has broader implications than just record retention, but a good email archiving solution may also have built-in surveillance controls and reporting to monitor and report on an investment advisor's actions and activity related to email usage and retention. Some reporting can assist with program annual review, which is a requirement. So up until now, I've talked very much about more email and IM communications. However, the newest development in this area of archiving and retention that is occurring is the move towards retaining information on social networking sites. The reality is that social media sites such as Twitter, Facebook, and LinkedIn have become mainstream avenues for business communications, even in the financial services world. And therefore, firms have to work diligently and carefully to ensure communications are retained for prescribed 3-year period of time. It's important to recognize that employees regularly may use these platforms and certainly would have no intention of doing something malicious to the firm. However, they may not recognize that a conversation that takes place via a LinkedIn messaging group or a Facebook messaging needs to be retained and archived. And that's why these tools such as Global Relays and Smarsh do provide that capability now to archive and retain communications that are sent across social networking sites if your firm allows employees to access those sites. That's another path that we see firms going down, is that they just restrict access to those sites, which is one approach that can be certainly taken. However, tying back to the mobile device trend, it is important to recognize that in many cases now it's just easy for employees to access these sites on their mobile devices. So locking down something on a work PC doesn't automatically cease access to that and prevent an employee from doing something, again, not necessarily malicious, but something that could put the firm or its information in harm's way. So something to consider as you devise your archiving strategy, as well as mobile communications and social networking policies.
Great. Thanks, Mary Beth. This concludes the direct results of our 2012 study. However, I know Steve wants to jump in here and talk about an overwhelming trend that we're seeing across the industry, and that is cloud computing.
So, as you're all aware, the shift to cloud-based or hosted technology solutions, otherwise called cloud computing, is really quite dynamic and impactful. And based on a study that was conducted by IDG Research Services in May of 2012, it was found that 8 out of 10 hedge funds and investment firms are currently using the cloud for at least some of their infrastructure or their application needs. And as you can see from the results here that we're showing from the study, that 65% of the firms rely on cloud for basic business / office functionality. Meanwhile, 50% of firms are actually using it for hosting financial applications in the cloud. So we can see that the level of trust in cloud computing is clearly increasing quite a bit. And a few reasons for this shift to the cloud is that really the cloud enables quick startup of operations without the significant upfront investment that you would need to make in order to build out an on-premise technology infrastructure. Also, most cloud solutions offer a pay-as-you-go or pay-for-what-you-use rental model similar to your home electrical bill, for example. This gives the firm more control over their operational expenses. And the last point I want to make is that cloud solutions allow firms to scale up or scale down their operations to meet the demands of their business. So it's this flexibility that's really a major benefit to hedge funds as well as other investment firms. But seeing that there's so much hype about cloud computing in the market, I imagine that the benefits that I just described are not necessarily new to you. So one interesting dynamic that I would like to share that we are watching is with the proliferation of cloud applications. As more and more application providers transition to serving applications from the cloud to their customers, it's possible and probable that many different cloud silos could potentially form. And this may present a management challenge for companies that are relying on a variety of different business applications, and these applications need to talk to each other. So the message I just want to leave you with is that for this reason, it's important to ensure the proper integration between these disparate systems that need to share information. And this should be an evaluation consideration when looking at managed service providers or selecting cloud applications in general.
Great. Thanks, Steve. So to wrap up, I just want to take a quick look forward in terms of what we expect to see on the technology front in the near future. As Steve mentioned, continued cloud adoption, particularly for infrastructure and application hosting your OMS, your portfolio accounting system, whatever it is, having that ease and flexibility. We expect firms to continue to navigate down that path. Regulations will continue to play an important role from a technology perspective with the implementation of Dodd-Frank and presumably other regulations in the pipeline. We saw Mary Beth mention, for example, research management systems. We expect that to ramp up in the near future as firms look to store and retain documents to meet any necessary regulatory inquiries. And finally, investors, have already become so technologically savvy. We expect that trend to continue and firms to really focus in on the due diligence process as they're seeking allocations and ensuring they're doing everything they can to manage risk and comply with both investor and regulator demands. So I'd like to thank our speakers today for joining us, Mary Beth Hamilton and Steve Banda. Thanks for presenting our 2012 Hedge Fund Technology Benchmark Study results. Hopefully our audience members found the information valuable. As a reminder, following the webinar, you will receive an email with a link to the recording today, as well as a full copy of our benchmark study report. After you exit the webinar today, a short survey will pop up on your screen. It's only 2 quick questions, so we hope you'll take the time to share your candid feedback with us. Finally, feel free to navigate to ECI.com, where we have a variety of resources and knowledge centers dedicated to hedge fund operations and technology. Once again, thanks to our speakers. Thank you all for joining us, and have a great day.